Welcome to The Deep Dive, your shortcut to being well-informed. Today we're diving headfirst into the H1 2025 earnings call for Gold Fields Ltd. That's ticker GFI. A real heavyweight in global gold mining.
Yeah, definitely.
We've got through all the details, financials, strategy, the works, to bring you the key takeaways.
And what a half it was for them. Goldfields put out results that, well, they didn't just meet expectations, they really blew past them.
Right.
It signals a clear path of growth, solid operations, and, importantly, really disciplined capital management.
Yeah.
We should explore what drove this performance and, what it means for their plans going forward.
Exactly. So whether you're already following GFI closely, or maybe you're just curious about what's actually moving the needle in the gold sector right now, this deep dive should give you that informed perspective without getting bogged down.
Mm-hmm.
Our mission today: break down the financials, look at the operational wins, and unpack the strategy that had investors feeling pretty good on the day. So let's kick things off with a snapshot. Gold Fields H1 2025 financials. This period really saw some significant beats across the board.
Yeah.
The company reported GAAP and headline EPS of $1.15. Now, just for context, the street consensus was looking like 59 cents.
Wow.
So that's almost a 90% beat.
Yeah.
And normalized EPS also strong at $1.12.
And the top line, the revenue for 8-1, just soared, $3.09 billion. That's a huge 40% jump year over year.
40%.
Yeah. And what's interesting is it wasn't just, higher gold prices helping everyone out. That was part of it, sure. But they also got a big boost from production.
Mm-hmm.
Output rose 24% year over year to 1.136 million ounces. But maybe the most eye-popping figure, adjusted free cash flow.
Nice.
It went from burning $58 million last year to generating a really robust $952 million.
It's quite a swing.
It's huge. I mean, that doesn't just look good on paper. It fundamentally changes their strategic options, doesn't it? It gives them massive flexibility, a real inflection point.
Yeah, that cash flow swing alone tells a big story about efficiency and, well, the gold price helping too, obviously.
Absolutely.
And for shareholders, the news was just as good. Gold Fields declared an interim dividend, 700 South African cents per share.
Which is huge.
A remarkable 133% increase year over year, basically matching their full year dividend from last February in just the first half.
Incredible.
And for anyone watching the mining sector closely, their all-in sustaining costs, AISC, that key metric showing the total cost to get an ounce of gold out actually improved.
Right.
Came in around $1,682 per ounce. That's a 4% reduction from last year. Shows real cost control.
And on the balance sheet side, they really shored things up. Net debt down from $2.1 billion last December to a much healthier $1.5 billion, which gives them a net debt to EBITDA ratio of just 0.37 times.
Very low.
Very low. I mean, they could basically pay off their net debt with less than half a year's earnings at this rate. Shows fantastic financial health, lots of room to maneuver.
And the market definitely took notice. The stock jumped, 2.84% on the announcement day?
Yeah, with high volume too.
Yeah. Clearly, investors liked what they heard.
No doubt.
Okay, so the numbers look great, but to really get Gold Fields' strategy, we need to unpack how they're building for the future while, optimizing what they have now. Let's start with Salares Norte. That's their key growth project, right? How's that coming along?
What's really impressive there is the steady execution. The ramp up is firmly on plan. They're targeting commercial production for Q3 this year, 2025, and then steady state expected by Q4.
Okay.
And they reiterated some pretty ambitious production targets, 325 to 375,000 ounces for 2025, then scaling up significantly, 550 to 580,000 ounces in 2026.
Wow, that's a big jump.
It is. And management also talked about successful winterization efforts, things like extra heat tracing, encapsulation, basically making sure it's resilient in that tough high-altitude environment.
Right, need that.
They even put in a bigger furnace in early August. That specifically tackles some previous issues with silver recovery and boosts the overall gold equivalent throughput. So it's not just hitting targets, they're actively de-risking this major asset. That's key for confidence.
Yeah, proactive de-risking, hitting targets, that's exactly what investors want to hear. But looking beyond just developing what they have, what about M&A? What strategic moves are they making to bring in other quality assets? I'm thinking about that big Gold Road Resources acquisition. a $3.7 billion, wasn't it?
That's a great point because that deal is a really significant portfolio shift, a game changer, I should say. Well, it consolidates 100% ownership of the Gruyere mine. That simplifies decision-making, makes capital allocation easier, and really crucially, adds long-life ounces in a top-tier place like Australia.
Okay.
The independent expert report actually backed up their offer price, too, said it was in a reasonable range.
Good sign.
Yeah. And as part of the deal, they'll get some Northern Star shares, but they plan to sell those off, see them as non-core, want to stay focused.
Makes sense.
And importantly, this also expands their Yamana land package around Gruyere, opening up more exploration potential there. So yeah, it's a clear move to double down on quality and simplify things.
Okay, so that acquisition definitely fits the focus on quality theme.
Yeah.
But what about their existing mines, the more mature ones? Any standouts there, or maybe any unexpected bumps in the first half?
Absolutely. Even the, let's call them legacy assets, are pulling their weight. It shows the impact of, focused operational tweaks and maybe some cultural shifts too.
Like where?
Well, South Deep, for example, saw a 31% improvement in attributable production. That came from better underground mining methods and improved STO turnover. That's short-term operations, basically moving material more efficiently.
Okay, 31% is significant.
It is. And St. Ives also delivered a 33% improvement in attributable production, mainly from higher open pit volumes and better grades. And Cerro Corona was up 24% for similar reasons, more volume, better grades. So these aren't just small gains. They're really vital for the whole portfolio's strength and show, systemic improvement across the board.
Good to see that consistency.
Yeah.
Now, speaking of strategy, with all this cash flowing in, how are they balancing things? Investing for growth, paying down debt, and returning cash to shareholders. That's always a tough act to balance for miners.
It really is. It's critical. And management specifically talked about a robust capital allocation framework. The goal is hitting all three. Invest for the long term, strengthen the balance sheet, and deliver upper quartile returns to shareholders.
And they have the flexibility now.
Exactly. With that net debt to EBITDA down at 0.37 times and nearly $1 billion in free cash flow, they can actually do all three pretty comfortably.
Okay.
Now, that 133% dividend increase, while huge, is still only about a 34% payout of normalized earnings. So still conservative, consistent with what they've done before, but and this is interesting, management explicitly said, given the outlook and the cash generation, they expect to be a bit more generous with shareholder returns.
Hinting at more to come.
Seems like it. They said more details at their Capital Markets Day. Oh, and one other small point. Some spending originally tagged for windfall got reclassified as exploration. Just shows they're flexible in how they deploy capital strategically.
Interesting. Okay. Beyond the financials and operations, they also highlighted ESG, environmental, social governance. What stood out to you there as becoming so important for investors?
Yeah, it really is. And their progress seems quite comprehensive, and they were pretty upfront about things. On safety, for instance, they're seeing benefits from improvement plans, cultural changes, 90% of internal recommendations done.
Yeah. But
they also acknowledge it's an ongoing journey, especially after 2 serious injuries. Shows transparency, I think.
Mm-hmm.
Diversity looks like it's genuinely improving. 28% women in leadership, 56% in core operating roles. That's a big step in this industry. On decarbonization, they've hit a 14% absolute reduction against their 2016 baseline, mainly focusing on renewables.
Okay.
But they were also candid about the slow pace of replacing diesel fleets because the OEM technology just isn't quite there yet for heavy mining equipment.
Yeah, that's a sector-wide issue.
It is. But to counter it, they're looking at other things like different material handling systems that could eliminate trucks from certain cycles. They mentioned examples like at Granny Smith.
Elaborate.
And critically, all their high-priority tailings dams now conform fully with the global industry standard on tailings management. That's huge for safety and environment. So yeah, it sounds like they're pushing hard on ESG, even where it's difficult.
Good to hear they're tackling those tough challenges.
Mm-hmm.
Now, looking further ahead, what's next in the growth pipeline, specifically Windfall, and how does that fit the longer-term picture?
Right. Windfall is still a key future project, but it's definitely a long game. The environmental impact assessment, the EIA, is moving along. They submitted the second round of questions to COMEX, that's the Chilean review body, in late July.
Okay.
Public consultation should be around the end of October. This keeps them on track for targeted EIA approval and a final investment decision, or FID, in Q1 2026.
Still a ways off then.
Yeah. And engagement with the Cree First Nation of West Winnipeg on the impact and benefit agreement is also moving forward. There's strong economic alignment there because the community actually owns the hydropower line.
Oh, interesting.
First gold is planned for 2028 after a 24-month construction period. We'll get updated capital cost estimates and the execution plan for Windfall at that Capital Markets Day later this year.
Okay, so quite a few moving parts, but it sounds like there's a clear, if long-term plan. How are they making sure they have projects lined up after Windfall?
Good question. It's about looking, a decade or more out. They're reinvigorating their greenfield exploration, doing it through equity partnerships mainly.
Yeah.
The idea is to build an early stage pipeline for future projects.
Exactly.
Yeah, they upped their stake in Onyx Gold, put money into a capital raise for VOR in Canada to fund drilling, and kept stakes in Hamlin Gold in Australia and Tesoro Gold for regional exploration.
Spreading the bets a bit?
Exactly. It's a proactive approach, and they're also spending on brownfield exploration near existing mines, about $63 million in H1. It's all about adding life and quality to the portfolio.
Makes sense.
Oh, and one last thing. The Vong mine lease in Ghana was renewed for another 12 months. Discussions are ongoing about handing it over to the Ghanaian government in April 2026.
Okay, got it. So let's pull all these threads together. What does this stellar first half mean for you, the investor listening in? I mean, Goldfields is clearly benefiting from this amazing gold price environment, right?
Precisely. Record near record gold prices. This powerful gold tape, as they say, has just amplified their strong operational results. They're getting more ounces at structurally better margins. And importantly, this isn't just the whole sector rising. GFI has seriously outperformed its peers. Look at the returns. Nearly plus 97.5% over the past year for GFI compared to the GDX ETF, the Gold Miners Index, which was up around 51%.
Big difference.
Huge difference. Shows their execution is really standing out.
And looking ahead, they reaffirmed their full year 2025 guidance. What should we be watching for?
That's right. They're targeting gold equivalent production of 2.25 to 2.45 million ounces and AISC between $1,500 and $1,650 per ounce.
Okay.
Management sounded pretty confident that costs in the second half will improve as some of those earlier ramp-up issues fade.
Good.
The big thing to watch, that Capital Markets Day on November 12th, that's where we'll get the longer-term portfolio outlook, updated guidance for 26 and 27, and crucially, more insight into that future shareholder returns policy.
The more generous part.
Exactly, including potentially bigger dividends. It really signals a strategic shift, doesn't it? From proving these big projects can work, proving the ramp, to now focusing on scaling and harvesting the value, like moving from R&D to full production.
Yeah, that's a key transition.
Very constructive path for the company, assuming they keep executing. And you have to mention the leadership, too. The CEO, Mike, has been there about 18 months now. Clear focus on culture, talent, mixing experienced insiders with strategic external hires. Seems like a solid team.
All right, well, for our seasoned investors listening, it is time for our This Is Not Financial Advice segment. Now, remember, these are purely speculative ideas, food for thought for your own high-conviction investment committee discussions. Always, always do your own homework.
Absolutely.
But with such a clear story and strong performance from Goldfields, it kind of begs the question, how might someone play this?
Yeah, you start thinking.
Okay, idea one, the dividend dominator, leveraged long. You've got this huge 133% interim dividend bump. You've got management explicitly hinting at more generosity later this year.
Right. The signal is pretty clear.
Combine that with the massive free cash flow, Salares Norte hitting full stride soon.
Yeah.
It paints a pretty compelling picture for shareholder returns, doesn't it?
It does.
So the trade idea, plausible but definitely aggressive, is maybe using leverage, perhaps through some carefully chosen long-dated options, to amplify the potential upside on GFI.
Amplifying the potential.
Yeah. The timing could align well with these catalysts playing out fully, capturing both potential share price gains from that cash flow and maybe a re-rating, plus that implied growing dividend yield. Leverage is the wild part, but the plausibility comes from management signals and the strong fundamentals.
Oh, that's one angle.
Idea two, the growth and green relative value play. This one's a bit more complex, multi-leg.
Yeah.
You go long GFI. You're betting on two things. Their focus on long life growth, think of Gruyere consolidation, windfall down the road, and their proactive stance on decarbonization, even with those industry challenges.
Okay, long GFI because of growth and ESG.
Right. Then simultaneously, you find in short a peer company. Maybe one that's struggling with project execution, or has a muddled capital strategy, or maybe have higher cost, shorter life assets in trickier places without a strong ESG story, particularly on decarbonization.
So playing the divergence.
Exactly. The wild part is picking that perfect short. That needs deep comparative work.
Sure does.
But the plausible side comes from GFI's track record on execution now, their strategic clarity, and that growing importance of ESG for big money investors. You're essentially betting GFI's scale and harvest story wins out, and you capture that performance gap, especially if gold stays high and ESG scrutiny keeps rising.
Interesting pair trade concept. Both definitely speculative, like you said.
Absolutely. Food for thought only. So let's wrap this up. Goldfields, H1 2025, really robust half. Impressive financials, clear operational gains, and strategic moves positioning them for more growth.
Yeah, the positive market reaction wasn't a fluke. It reflects growing confidence that Goldfields can really capitalize on these strong gold prices and deliver on its growth plans. With Salares Norte ramping, the Gold Road deal bedding in, and that disciplined capital approach, GFI is definitely making a strong case for itself as a top-tier name in the gold sector right now.
We hope this deep dive has given you some valuable insights into Goldfields' latest performance and where they might be headed. As always, remember this is purely for educational purposes, definitely not financial advice.
Please do your own research.
Absolutely. Keep digging, maybe consult with a financial advisor, and perhaps leave thinking about this. Beyond GFI, what's the next big strategic pivot you anticipate in the gold mining world, and who else might be well positioned for that? Something to chew on. Thanks for joining us on the Deep Dive.